This is Michael from Scottsdale, Arizona. It is Tuesday, December 15th, 2015. It's beautiful here in Scottsdale as normal. All 200 golf courses are open. People are playing. It's absolutely gorgeous out here in the West. So I need to get my disclosures going. I am not a licensed stock and bond broker, nor am I a licensed financial advisor. I am do an awful lot of investments here in Arizona for myself and for clients. So I'm reasonably well versed in investments and what's going on in the world. Listen, a couple things that are concerning me. I do want to review a couple things. I have been advocating that if you're Canadian, that you need to sell your properties. You need to get rid of your stuff in Canada. You need to get rid of your stuff here in the United States. At the point, we're about 135 Canadian dollars to $100 US. So if you sold things here in Arizona, why you would get a 35% premium, which you can take back. And of course, we've been talking about that since January, February, March of this year. And of course, things just keep getting more and more difficult for our friends to the north, and in particular in Alberta, which is the oil country. We were pretty right in that call. I have been advocating to get out of stock and bond market. Stocks are still holding up pretty doggone volatile. Most of the an awful lot, over 50% of the S&P is down below their 50-day moving average, which means that there's several stocks that are really holding up the indexes. So we're right in that call. And quite honestly, we're really, really concerned. I've been talking about the bond market. I've been right on that recall too. And here's what's going on. I mean, you have the junk bond market with the HYG. It's a symbol on JNK. There's an awful lot of other hedge funds and smaller high-yield funds, and a couple of them are starting to liquidate, and they're putting gates up so that you can't get your money. Now, a lot of this is because a lot of this these junk bonds, there is no liquid market for them. So if you have bonds that are triple C, you can't sell them. So if you have a redemption and you have to pay your clients. They're asking for their money. That means you have to sell your really good bonds to do that. So if you are a junk bond, so if you've got some Bs in there, you can't sell the Cs. You got to sell the Bs. Pretty soon you run out of the Bs, and all you have is a bunch of junk. That's what happened in our 2008 meltdown. Now you have to realize that sometimes this just flows over. So your high yield, if you run out of liquid high yield bonds to sell out of your high yield fund, then what you end up doing is liquidating other things. They start going into corporate bonds, and it gets to be a contagion. So what we're saying to you is that if you're going to sell, you want to be one of the first ones to sell. We've been talking about this since March, April, and we've been correct on that as well. I'm also telling you, I think that the stock market is probably well oversold, and profits are just not going to stay at this level. And we think that, I think that prices are going to be significantly lower next year, and I think we have a problem with that. Now, I think that it's time to start thinking of taking some money out of the stock and bond market and putting it into alternative investments. Now, it's just too early to start putting it into any commodities. You can't put it into oil or gas. As you know, I've talked to Walter Zimmerman, and Walter Zimmerman still thinks that we'll probably have commodities down until late 2016, maybe early 2017, which means that anyone that's in the commodity sector is really going to have a very, very difficult time, which means that all our Bakken reserve, and keep in mind that I've been told there's $4.8 billion from the Bakken reserve that's on default watch, $4.8 billion. That's going to really put a dent in an awful lot of companies if these things start going in default, and they're on default watch. So what do you do? Cash, probably some very short-term treasuries. I'd like to think that real estate's going to be a really good investment. We're going to probably have a correction, and I wouldn't use any money coming out of your personal savings that are reserves, but I would certainly think maybe you want to take some of the money, if you take off the stock and bond market, that you start considering putting some of that money to work in the real estate field. Now, I wouldn't be buying warehouses or vacant land at this point, but I think you can look at some very good income property, medical buildings, single-family homes that you can turn into rentals, and multifamily, things that generate a consistent income for yourself, and keep in mind that that income is going to be extremely important if we do go into recession, which we've been talking about, that recession is at hand. It looks like it's imminent, and we may be in it now. We just haven't recognized that. So some income properties would be really good. Now, I do expect to see lower prices going forward into maybe early next year. In which case, if you're going to buy them, you probably want to pay cash for them then. If you need to finance any properties and you want to leverage, and you want to maybe leverage 3 to 1, which is fairly conservative, maybe 35% down, then probably you want to consider that now. 'Cause I do believe 5 or 6 or 7 years from now, you are going to see significantly higher real estate prices across the country. And of course, my home office is here in Phoenix. We'll be one of the top 4 growth markets in the nation, so we're expecting really, really strong growth here in Phoenix. But it is 5 or 6 or 7 years out, so I feel reasonably comfortable if you purchase a piece of property here with, remember, most of our holds are 5 to 10 years, that you'll be fine with that. In the meantime, you'll just be stripping out the cash flow component, and which is going to help. You know, if you get 5 or 6 or 7 properties or 10 properties that are all cash flowing nicely for you, really helps to mitigate any kind of downturn that we have. So we're looking for asset preservation, and a lot of our clients are thinking, I'd like to get a return of my investment, not necessarily a return on my investment. And quite honestly, if you are overseas, or if you're from Europe or from Asia and you want to get your money out, keep in mind that we're still projecting higher U.S. dollars, and you can get into the real estate field and probably preserve it, because it is a separate asset class. The direct ownership of real estate does not correlate very well at all with Wall Street. So we're more of a regional correlation, and when there's growth, there's appreciation. So although we are economically sensitive, we're not necessarily correlated with Wall Street. So if you have a Wall Street panic, that doesn't necessarily flow over into the real estate business. But now there's a couple things that you need to be concerned about. We are looking what's going on in the world, and it could happen pretty fast. So we are always interested in listening to what you may have to say. I answer my phone. You're welcome to call me here in Arizona. And I want to wish you the very, very best. Now, let me just recap. Probably want to talk to your advisor about your stock and bond exit portfolio for yourself. You want to really take a look at your bonds. And we might want to start thinking of getting into some kind of cash flowing income properties for yourself as a separate asset class for asset preservation. So I'm going to wish you the very best. Tomorrow is the date to find out if we're actually going to have rates rise or not. And I wish you very well. Bye-bye now.